Before the FDIC insured all banks in the United States, some states tried to create their own insurance programs to secure banks. The first came in 1829, when New York State launched a statewide insurance program. This program was apparently inspired by merchants in Sichuan, China. A businessman named Josh Foreman came up with the plan after hearing about how Chinese merchants protected their businesses from financial ruin. All the banks in New York had to pay into a central insurance fund. If one of them ran into trouble, the fund would step in to cover their losses. On top of that, a board of commissioners was created to audit banks and make sure they weren't running wild with any bad loans or shady practices. New York's system seemed to work, and between 1831 and 1858, 5 more states set up similar programs. These early programs had no dollar limit on how much depositors were insured for. If a bank failed, the insurance would try to cover everything, not just a set amount per person. Also, these early insurance programs didn't just help depositors. They also protected banks in other ways. For example, if a bank issued paper banknotes, which at the time were essentially IOUs for gold and silver, and then couldn't afford to redeem them, couldn't exchange the notes for gold and silver, some of these insurance programs would step in to redeem the notes for the banks.